Boosting your borrowing prospects. Buying a home should be exciting. So what can you do to improve your borrowing prospects and make your experience that much better? Here are some ideas to help you out. Don't look to borrow 100% of the purchase price of the property. Instead, aim for having a deposit of at least 10 to 20%. The earlier you can start saving for your deposit, the better. Banks will look for a good savings history. It shows that you're able to manage your money and manage it well. Keep in mind that tougher lending criteria might mean a lender will look deeper into your employment and financial history. For example, how long you've been employed in your current position. So if you have a good job, stick with it. Lenders can also access further information about your credit history, so it's important to pay your bills on time. Make sure to eliminate other debts, pay off any outstanding loans, finalise your credit card debts, and reduce your credit and overdraft limits. Even if you're not using them, high limits will reduce your borrowing potential. Remember that documentation is important. Be sure to have all the supporting papers ready to quicken the process. This includes payslips, group certificates, and tax returns. You need to be realistic. Don't seek a loan size you know you cannot service. This will only hinder your chances of getting the house you want. Seek the services of an experienced broker rather than limit yourself to one bank. We can assess your borrowing capacity as well as advise on the right lender and product type that suits your needs. Contact us today.
Most of us don't think twice about recycling our plastics and paper waste to help save the environment. But what about recycling debt? Is that a good way to save money? Debt recycling is the process of replacing mortgage debt, or bad debt, with investment debt, which is known as good debt. This strategy enables investors to start building wealth while they're still paying off their home. As equity is built up in their home, funds are redrawn and invested. Income from these investments can be used to further reduce the mortgage balance, while the growth component contributes to wealth accumulation. Why is debt recycling a good strategy? The main benefit of a debt recycling plan is the ability to accumulate wealth tax effectively. This is achieved as investors use the income earned on their good debt to pay off their home mortgage, bad debt. But take note, the tax effectiveness of a debt recycling strategy is dependent upon the individual's marginal tax rate. The higher the tax rate, the more tax effective the strategy, and vice versa. As such, tax advantages should not be the primary basis for using this approach. Debt recycling also provides investors with an opportunity to fill the gap between their superannuation savings and retirement objectives. For many people, super will be insufficient to fund their desired lifestyle. Additional wealth accumulated as part of a sound debt recycling strategy may be able to fill that void. Are there any downsides? Perhaps the biggest risk associated with this strategy is the threat of compounding losses. Whilst a geared investment strategy can help to build wealth faster, the opposite can also be true when markets experience a downturn. In a worst-case scenario, investors can end up owing more than the portfolio is worth. If you use the equity in your current home as security for the loan, you could be at risk of losing your home. Debt recycling is not recommended for anyone with an investment time frame of less than 5 years and is only suited to those investors with a reasonable appetite for risk and a secure income source. How do you start? To commence a debt recycling strategy, investors should first ensure they have the right loan structure, as some of the investment debt will have deductible interest costs. These amounts should be kept separate. A loan facility allowing separate sub-accounts is preferred, with the ability to choose between principal and interest. Interest-only repayments are also desirable. Debt recycling can benefit investors prepared to invest not just funds, but also time and patience. Want to know more? Contact us for more details. Debt recycling in action. Debt recycling is the process of replacing mortgage debt, or bad debt, with investment debt, which is known as good debt. This is how debt recycling worked for one couple. Mark and Jane have built up considerable equity in their home and, upon advice from their financial planner, decided to make the equity work harder for them. The couple currently owes $240,000 on their home, which is valued at $400,000. Their licensed planner recommends Mark and Jane implement a debt recycling strategy, refinancing their current loan to give them a $300,000 loan limit. This releases $60,000 of available equity for investment. Mark and Jane's planner recommends they invest their $60,000 equity into a portfolio of managed investments specifically chosen for income potential. After 1 year, their portfolio has grown in value to $65,000 and yielded an income of $4,000, which is used to pay the interest on the investment loan. Any surplus is used to reduce their mortgage further. After regular loan repayments, their mortgage balance is $230,000 after the first year. The couple then draw the extra $10,000 in equity to make an additional contribution to their investment portfolio. This process is repeated each year until their mortgage is extinguished. Debt recycling can benefit investors prepared to invest not just funds, but also time and patience. Want to know more? Contact us for more details.
What is a managed fund? A managed fund is simply a pooled investment vehicle, which means that a number of investors have contributed money to the fund. An investment manager then invests the funds on behalf of the unit holders. The main advantages of using a managed fund to invest are: the money in the fund is managed by a team of investment professionals. You can get exposure to investments that you, as an individual investor, may not otherwise be able to access. For example, international shares or shopping centres. Managed funds are typically diversified. Some funds may hold shares in 30 companies, while others more than 100. Some may invest in property, while others fixed interest assets and cash. As a unit holder in the fund, you're entitled to receive income distributions based on the number of units you hold, and these can normally be reinvested back into the fund or paid out to you. At tax time, the fund manager will prepare a statement for you that gives you and your accountant all the information they need to complete your tax return. On the flip side, the disadvantages to using a managed fund are: you have no say on how your money is invested. The fund manager makes all the decisions. It's impossible for a fund manager to be able to take all unit holders' individual circumstances into consideration when making investment decisions. So from time to time there may be tax to pay on distributed capital gains or income. Unlike accessing a bank account or selling shares, it typically takes 10 business days, this can be longer, for withdrawal requests to be processed. Fund managers charge fees to manage the investment portfolio and to cover their administrative costs. There are a large number of managed funds to choose from, which is why it's important to seek advice on which managed fund is right for you. Reading the product disclosure statement your advisor will give you is also important so you can understand how the fund operates. If you require more information, please contact us.